Okay. Can you all hear me now? Okay, I can hear you all. Can you hear me now? Can you hear me?
Yes.
Okay. Oh my gosh, I do not know what is going on. I'm so sorry. Okay, and Mr. White's on too. We're all here. Let me make him a host and we'll get started right now. I apologize. We do this every single day. It's never a problem. I don't know what is going on today. So thank you all for your patience. We're going to keep it short, sweet, and to the point because he's doing this as a favor to me. I've already pre-asked him some questions, so I'm going to make you a host. And okay, you're unmuted. Try out your sound and make sure you're unmuted on your end.
There you go. Can you hear me?
Yep, we can hear you. Everyone else is muted, so I apologize about the technical difficulties. I have no idea what happened. But thank you for your time first and foremost. So as most of you know, and we're all getting these 1099s. So a lot of associates are kind of new and just kind of experiencing the whole 1099 deal for the first time ever. So if you can give some tips, I've asked him some questions and he's going to give us some basic info to help our tax season be a little bit easier. So if everyone can mute yourselves, I need everyone to mute yourselves because I hear a lot of background noise so that we don't interrupt everyone. So if you're not muted, please go ahead and mute yourself. And I'm just going to turn it over to you. Again, this is my CPA. He's amazing. He helps me out. He's my sanity. And he's going to give you all some really good tips. And I'm just going to turn it over to you.
Okay, perfect. Well, one of the first things I was asked, thank you for having me, by the way. Well, one of the first things I was asked to sort of cover was when is it a necessity to sort of consider an S corporation, right? Because you all essentially own your own business by doing this. There comes a couple of ideas of when you should be an LLC or when you should incorporate as an S corporation. I'm going to go into this one because this is kind of the hard question. This is kind of I like to eat the crusts of the pie first, and we'll get to the fun stuff like deductions in a bit. But an S corporation, the reason you want to consider that in the future is when you start to make net operating income, that's after expenses, around $30,000 to $40,000 a year. When you start to make that much a year, you want to consider this because the S corporation has a benefit where you can distribute the earnings from the company that are all non-subject to Social Security tax and Medicare. So you essentially receive a 15% reduction in tax on all of the excess. But the problem with that is you have to do a bunch of complicated accounting stuff and payroll and a few other things that can cause a bit of a headache. Normally we say around $30,000 to $40,000 NOI with net operating income because if you have to do your own books, at minimum it's going to cost about $900 a year in software costs. Payroll, it's about the same. And additionally, a tax return can be, on average, our corporate tax return is probably around $1,500 a year. So when you factor in all of those details, you're looking at about $3,500, right, in expenses to justify an S corporation. The reason we say around $30,000 NOI is because that's $4,500 in tax savings. So it starts to make sense around that time when you're making that much money. But it definitely makes more sense as your income increases, right? So that's a big step when you start to stabilize, when you see your career doing very well. You go ahead and you pay yourself reasonable compensation, you monitor your books, and you work with that. Now, before you do that, you want to consult a CPA, and you want to make sure you're earning at least about $30,000 to $40,000 a year after expenses. So that can probably equate to $50,000 gross, right? That's probably the most complicated bit we'll get into today. Everything else is a lot more simple, a lot more fun. Like, for example, some popular deductions that you can now run through your business. Now, it used to be, now, real quick, I want to kind of go over the idea of a deduction. Is a deduction a good thing, right? Is a deduction a good thing? It's not, right? Because at the end of the day, which would you rather have, $10,000 or a $10,000 deduction? You'd rather have $10,000 in your pocket, right? But if you're spending it on something you want or you've already made up your mind, then a deduction's a fantastic thing, right? The way I look at it is you want to find out your sort of effective tax rate. And then that item that you purchase as a deduction is suddenly discounted. So for example, I like gadgets, I like gizmos, I like technology. I buy new phone almost every year. The way I consider it is if I have my effective rate, let's say it's 25%, if I were to buy this phone at a 25% discount, would I? And I'm doing it regardless, but now I get a 25% discount because it's a deduction. So when I look at deductions, the things that you're going to start writing off are these essential items to this business, like this cell phone, right? Because your telephone bill, your cell phone bill, I guarantee you're calling a lot of clients, you're having a lot of clients call you, that the predominant usage of it, checking emails and all that, are going to be through your business. So you get to claim your cell phone through your business, which is going to be great, right? Because if you're already on a plan, then this essentially discounts that plan by your effective tax rate. The other thing is mileage. Now you get to claim mileage, which is also great, right? Because with mileage, hold on, I just lost the screen. With mileage, you now can claim 54.5 cents per mile. So every time you have a personal mileage, you want to separate that, right? There's an easy way to do this, and we like to tell clients to download an app called Mile IQ. That's very important. Write that down. It's simple because whenever you swipe right, I believe it's classified as business mileage, and when you swipe left, it's classified as personal. And what we advise our clients to do is sort of have a home office. And the home office deduction is very specific. You must have a room that is designated as a home office. That means you can't put other stuff in it, right? But just make it a designated space. And then every single mile you drive from one place of work to another is considered a mileage deduction. That's exciting because you know what I do every morning? I walk into my home office, I check in, I check my email, then I drive to my office in Tioga and I work out of there, and then I drive back to my office and I check into my email and I do some work in my home office. That means whenever I leave my house, that's a business mileage when I go to another place of business. Or if I go meet with a client, right? So if I go meet with a client at, say, I love to take clients out to eat. I love to go get coffee and all that stuff, and we'll discuss work there. And if ever I meet someone there, that is business mileage. And that's an exciting other detail you have, because now whenever you take a potential client out to get coffee, you can buy them coffee, you can deduct that, and then you can also now deduct the mileage. But you want to make sure you have a place of work that you're starting with, a home office. Additionally, if you pay rent or if you own your house, you get to deduct either the rent, the mortgage interest, the repairs and maintenance, the insurance, the property taxes in proportion to the home office, to the home. And so that adds these sort of what I like to call almost phantom or intangible expenses. These are expenses that you're going to realize without actually having them leave your pocketbook, right? That's a great thing, especially with mileage, because you're going to 54.5 cents, unless you're driving a car that gets 4 miles to the gallon, you know, you're going to be making money on that even after the repairs and maintenance. Almost every single person we know who drives a great deal of mileage, let's say 10,000 miles or more a year, they end up making more money off the deductions than they do off spending it out of their own pocket in terms of gas and repairs and maintenance. Mileage can be huge. So those are the two sort of fun deductions, because those never leave your with the phone as well. That's something you're already paying for, and the home office and the mileage is cash that never actually leaves your pocket. That's exciting, right? Because what that ends up doing is lowering your tax your tax liability, and you find yourself with less taxes to owe at the end of the year.
Hey, real quick, I saw this question in the comments, and I'll try to filter them to you. The difference in an S Corp and a C Corp. Can you touch on that really briefly? Okay,
so this is the main thing I would touch on. None of you want to be a C Corp. None of you want to be a C Corp right now, and I'll explain the reason why. A C Corporation essentially gets taxed twice. So you get taxed first on the income the C Corporation makes, which is a 21% tax. And additionally, you get taxed every time you pull money out of that C Corporation because it's a dividend. So the reason you would want to do a C Corporation is if you have more than 100 shareholders, if you have a large company you're piecing together, if you're trying to put money into it as a means to get taxed at a capital gains rate over time, and it's more of a C Corporation is very good, but it's good in a large scope. What I would say is if you're doing about $25 million in business or more, absolutely a C Corporation. If your main goal is to sort of shelter money and pull it out at some point for a capital gain, absolutely a C Corporation. But if your main goal is to start a small business and make good money where you probably end up making $400,000 or $500,000 a year, $1 million a year, something like that, and grow to that scale, you want to keep it in an S Corporation. One, it's cheaper. It's much cheaper. And two, it has huge tax savings because it's what we call a flow-through entity, right? A flow-through entity means it's taxed at your level. So if the company makes money, you get taxed on it, but you only get taxed once. You can take money out whenever you want, and you're not taxed on it. You're taxed when the company makes money. The C Corporation, you get double taxation. So in most cases, there are a few cases, and you want to talk with your CPA about this, but there are a few exceptions to the rule. But as a general principle, it's good to keep it as an S Corporation. Any other questions regarding that?
No, we're just moving on. One other quick question to follow up is someone was confused, and I could misunderstand, so I want to make sure you clarify this. They can't claim mileage and maintenance and stuff like that. It's one or the other.
It's one or the other. You cannot claim both. You cannot claim both. It's one or the other. So a good example of this, there's a couple of ways you can do it actually. What we call it is actual expense versus mileage. And in most cases, if you're driving around a lot and you're seeing a lot of clients, most cases mileage makes sense. However, this is the one exception. If you do everything from your home and you make a ton of phone calls and you do everything from your home and you somehow manage to run your business that way, a good example, I'm a penny pincher. I have a 10, 12-year-old car that I drive into the ground because I like to do that. Everyone gives me hell about it, and they say, you need to get a new car, but I like to squeeze my pennies. I'm saving for the future. But I could actually go out with a very nice luxury vehicle, and that luxury vehicle, I can lease it and write off everything as a deduction. Or I can buy it, and now luxury deduction is a $50,000 vehicle or less. So there are a lot of tricks to come to it. Mileage isn't always the best answer. It's kind of like if someone asks how much does it cost to paint a house, it depends how many windows you got, how much square feet is it, right? That's the same thing with tax. Mileage isn't always the answer, but from what I've learned in your industry, it typically is. Not always, but typically is. You still want to communicate with your CPA about this. I saw a question pop up. It said, so an S Corp, not an LLC? Well, you can create an LLC. An LLC to be taxed as an S Corporation. An LLC isn't actually a tax structure. An LLC can sort of be planted onto other tax structures. So for example, you can have an LLC that's a partnership. You can have an LLC that's an S corporation. You can have an LLC that's a sole proprietor, or an LLC that's a C corporation. The tax structures are sole proprietorship, right? A partnership, a S corporation, a C corporation, and then rental property and farms, right? So an LLC can sort of piggyback its way onto all those things. An LLC sort of operates as a liability umbrella. And when you do that, I can't advise on so much because it would be me practicing law, and I don't want to do that, right? Because there's attorneys out there who are more capable than I at advising on that. But the way you treat an LLC is almost as a liability umbrella. Okay. So what about those of us that make 0 to 29? Same rules as an S corporation. The same rules apply. The reason I wouldn't suggest becoming an S corporation at that point yet is because when you're an S corporation, the costs sort of outweigh the benefit at that point. It can still make sense to do it, but you're going to find yourself dedicating a little bit more time and spending a little bit more on tax preparation fees. Like, for example, if you're Schedule C, your tax return may be, if you're a sole proprietor, LLC, your tax return, individual tax return may be something like $500-$600, right? If you're a LLC S corporation, you have a corporate tax return that's probably going to be about $1,500. And then you have a personal tax return that's going to probably be about $300. So when you combine that, it doesn't make sense until you start making enough money where that deduction, where the QBID deduction and where the Social Security deduction start to outweigh those costs. That's to me, and to me, it really can trigger around $28,000, something like that. But I say, let's just be safe. Let's do it around $30,000 to $40,000, because you never know. There's always these hidden costs that sort of poke their heads up, right? And you never want to be surprised. You never want to lose money on an S corporation. The other sort of intangible benefit from an S corporation is most fraud is committed on sole proprietorships, right? I have clients come into my office all the day and they say, I want to deduct a boat. And I say, well, are you seeking to make a profit with that boat? And they say, nope. I say, are you doing charter fishing tours on that boat? And they say, nope. And I say,
Joanne Fluke.
Well, you cannot deduct a boat. And they go, well, I have a friend who graduated from Harvard Law, and they said, I can deduct a boat. And I say, well, have them do your taxes. But the law is clear. You cannot deduct a boat. And so with that in mind, a lot of, whenever there's an audit, all of this stuff is automated, right? The IRS will trigger, they always look at the sole proprietor and first, right? Because that's where most fraud is committed. So there's also a little bit of a benefit with an S corporation. It legitimizes you. And by legitimizing yourself, you are less likely to be subject to auditing. But that's something you don't need to worry about if you're doing everything straightforward and you're being honest with it. It helps with it. But that's another added intangible benefit. All right? Any other questions? If you have other jobs, you can absolutely file everything together. Yes. Now, what you want to do, if you have other 1099 jobs or contract labor jobs, what you want to do is you want to separate all those expenses out and all that income out. You want to keep them isolated. All right. So the reason being is the IRS has a bit of a rule. They call it the hobby rule. And if one of the contract labor jobs produces a loss in 3 out of 5 years, they consider it a hobby. It's something that's newly been pushed through. And if it's 2 out of 5 years, if you have a profit in 2 out of 5 years, it's still considered a hobby. But what you need to do is have a profit 3 out of 5 years. You can claim losses the first 2 years. And then at that point, it's considered a real business. So with that in mind, you want to keep your expenses. If you have multiple 1099 jobs, you want to keep your expenses, your revenue, and your expenses completely separate. on both streams of income and both streams of expenses, because that way the IRS can see which is allocated where. All right. Any other questions regarding that? I have the chat window pulled up now, so this makes it a little bit easier. Let's see. All right. So now we'll go into some more common deductions. So now I said you can deduct meals. The way I would deduct meals is if you go out to eat, if you buy someone a cup of coffee or something like that, just write down who you're with and what you discussed. And that's what you need to provide. Additionally, you can only deduct 50% of that meal. So if you were 30%, if your effective tax rate was 30%, that means you would only truly get a 15% deduction on that meal, right? So just keep that in mind. You would provide your CPA with 100% of your meal tickets, and they would calculate out the 50%. But at the end of the day, the meal deduction it's an added benefit. If you're going to already take someone out to lunch and do that, an added benefit. The other things, there's a couple of myths when it comes to deductions. A lot of people think, oh, you can deduct dry cleaning. You can deduct haircuts and presentation. You cannot. The only sort of clothes you can deduct are if they have a logo on them. Right. The only sort of dry cleaning you conduct or if you do hazmat cleaning where it's sort of involved. What I would just say is consult your CPA. Do not use Google as a toolbox, because there are a lot of people who completely misinterpret the tax code, and it's very easy to do so. And I like to call them blinders. A lot of people hunt for deductions and they put on rose-tinted glasses and they go, oh, I can deduct this, when a lot of times you can't. But it's the same thing. You'll see some people who say, oh, I can't deduct this, but there are the benefits where you can actually deduct this. And laws do change too often. A good example of this is a lot of people fear the home office deduction. The home office deduction is perfectly safe. Just make sure you have a room that's designated as a home office. Don't make your kitchen the home office, right? Let's see about this question. Hobby versus business. So a hobby, what they consider a hobby is if you are losing money 3 out of 5 years, they consider that a hobby, right? If you spend more money than you earn. So for example, okay, you understand it. All right, that makes it easy. Nicole, I see you have a question.
Sorry, I couldn't find the mute button. So you're telling me if I go out and I buy a $200 dress for our corporate events that we go to, I can't claim that dress?
No, absolutely not. Absolutely not.
Oh man.
Yeah,
okay.
That's it's unfortunate, but you cannot claim a dress because the IRS is. We have a bit of a saying. Pigs get fat, hogs get slaughtered, right? And so the IRS is going to see that, and they're going to say, well, are you going to wear that dress at any other event? Well, you can wear it at any other event, and they're going to sort of argue it that way. And it's unfortunate, but it's the same thing. I have to wear button-up suits and everything like that to work, and I used to wear a tie, and I don't do it anymore. But God, no one wants to wear a tie. But can I deduct a tie? No, I cannot.
That's good. And let's talk about, let's go to convention. I think that's a good one.
Conventions are huge.
Questions on. Yeah,
yes.
Go ahead and elaborate on that.
So here's the rules with convention. Plane fare, traveling, the actual convention itself, the hotel stay, the meals, all of that is deductible. So I have me and my partner, we work together, and we're in this for the long haul. We both take our wives out to we'll take our wives out on these trips, these convention trips, and we'll be able to deduct the hotel. We'll be able to deduct, as long as the convention lasts, we'll be able to deduct that, right? Now, if you stay any additional time, you separate that out. Does that make sense? So if I go out to eat, I can deduct that. Let's say the convention is Monday through Friday, and I'm there Monday, and I fly out Sunday, and I land, and I stay for an additional week. Well, that plane ticket and that whole hotel stay for the first week through the Monday through Friday, as well as all the meals Monday through Friday, that's all deductible. The convention costs, all of that. But if I stay an additional week, that's all personal. All right. Do you follow me? So that's a big thing.
Can I ask a question?
Yes.
About that? Okay. But is there a caveat where there's like, say I go and I take my husband, but he's not working the business. I can't write off his plane ticket, correct?
What you do is you write off 50%.
Okay.
Does that make sense?
So it is allowed for me to write his trip off.
No, both of you are going. So you spend $300 on plane tickets. You would only write off $150. So you would write yourself off.
So basically just write all of mine off, but not his.
Exactly.
Right. Okay.
But there is the benefit because you get to go there regardless. Does that make sense?
Sure.
Quick question. So this is a gray area. And my new
You're breaking up.
Is I need a CPA and have scared person, so I'm gonna need you to step it up. Oh, okay.
You can deduct food expenses. I see that Heather asked if I couldn't hear you. You broke up. What was it? Okay, you can deduct food expenses. It used to be called meals and entertainment. So meals and entertainment is now just transitioned to meals. What they eliminated is I used to go out and buy, there's two different types of meals, right? Or three technically, with the travel. But I used to go out and buy meals for my employees. We have probably about 16 employees. And I used to go out there and buy meals for my employees and bring them back to the office so they would stay and work. I can't do that anymore. Now, that is no longer 100% deductible. But what I can do is it is 50% deductible if I buy meals. Does that make sense? So there's a couple of changes with food, but you can buy. Now, if I go out to Publix and I buy food for my family, I can't deduct that, right? If I go to Publix and I buy a bunch of food and I say, oh, lump it in, I can't do that, right? But if I go out to eat or if I buy some food for some employees or some clients, I can deduct 50% of it. What if you're paying for another associate to come under you or on your team? Yes, you can pay for that person. That you would then have them fill out a W-9, and that W-9, if you're paying for that person to work for you to do some work, you want to look up Florida legislation on what makes an employee versus a contracted labor, right? And consult with your CPA first. And with that, you can absolutely deduct all of that that you pay them.
Couldn't you treat that as like a contest winning though and just put it under that? Like they won a contest and so you paid for them to go, like a contest giveaway?
You're talking about if you paid for a person working under you to go under a trip, you can write that as a bonus, yes, or
okay.
But you would still 1099 them, right? You 1099 in excess of earning over $600, okay?
But if they're already a 1099 with the company under you on your team, you can treat it as a bonus instead because the company's going to 1099 them.
Yes, right. Absolutely.
Okay. I know a lot of us do that, so I just thought I would ask that to clarify, to make it easy for everybody.
That's fair. Yeah, you absolutely. That's deductible, and you treat that as a bonus. And that income on their end, they would flow through and deduct it. Does that make sense?
Mm-hmm. Yes.
Okay. Yes, food receipts when traveling count. Yes, that's a big thing. That's a very big thing. So the other questions I saw were, can we claim personal products? If you're using them for personal use, you cannot deduct them, right? Now, if you're giving people gifts to get people on board, And this is one of those areas where I want to remind you, pigs get cute, they slaughter hogs, or pigs get fat, they slaughter hogs, right? And the other one is pigs are cute, they slaughter hogs, right? So if you can give people gifts of product, and or you can advertise by giving people gifts. The problem with gifts is you can only deduct $25 per gift. Okay, does that make sense? Per client. So if I give a product, if I give $50 to you, $50 to $25 to someone else, at the end of the day, I get a $50 deduction only because I gave $50 of gifts to someone else when it should have been $25, right? Yes, you can claim orders of product each month because you intend to sell it. Absolutely, absolutely. That's put it this way. If you're seeking to run your business, right? That's the bread and butter. We call it economics. We call them widgets, right? That's just the universal term for selling anything. Whenever you buy a widget, it is absolutely deductible. Okay. Any other questions regarding are these tax laws the same under every state? They do vary. They do vary state to state. Most of the tax laws are the same, but where state tax law sort of gets in the way a little bit is they'll treat some sales tax differently. They'll treat some different forms of income differently. And so you do want to pay you do want to be mindful that cell phone bills, absolutely deductible. I'll tell you, 100% of my cell phone usage is business. 100%. I'll text some personal stuff every now and then, but I am not arguing that any less than my cell phone bill because all the time I'm on the internet with it's email and it's maps to see clients. It's this. That is still 100%. I would say deduct your cell phone. So all giveaways are tax deductible up to 25%. Or $25, not 25%, up to $25. Now, here's the difference. If you give away something with branding on it, if you give away something where you're advertising and building your brand, there's a gray area here where I would suggest consulting with your CPA about, because advertising is 100% deductible. Right. And then also giveaways like as an advertising thing. So for example, let's say I give away product at a silent auction and I'm advertising me as a business at that silent auction. I would 100% argue that is advertising. That's not a gift. Do you follow me? And because a gift is 100% deductible. But whereas not a gift, advertising is 100% deductible, whereas a gift is only up to $25 per person.
Okay, we have trial packs, and they cost us $13 and then $2 or $3 to ship them. So
okay.
Would that be completely written off? And when we do that, do we need to keep their name and everything as to who we sent it to?
That one. In the case of the trial pack, if your trial pack costs $200, you could write that off because you're buying product. Does that make sense? It's more if you're gifting someone. Like, for example, my wife, she works in real estate. And she will occasionally, if someone buys a home, when someone buys a home with her, she gives them a bottle of champagne. She gives them a big gift basket. She gives them all these chocolates, all these cookies, all these exciting things because she wants it to be an experience of purchasing a home with her, right? All of that she probably spends about $120 on each client she sells a home to, right? And all of that is only deductible up to $25. But she does it anyways because she wants to reward them. But that is something unrelated to product, right? If you are buying a trial package, that's not a gift. You're actually going out and you're buying something to give to someone. I would argue that's advertising. So if there's a difference between a gift and advertising, right? And that's something you kind of want to consult with your CPA, because these are one of those gray areas where people have different flex. And we can go back and forth on this all day. Postage is absolutely deductible. Postage is absolutely deductible. Monthly kit orders to stay active, absolutely, those are deductible. Advertising is 100% deductible. You have to order X amount of products to get paid. If we use any of that purchase, it's not deductible. Correct. Even though it's a requirement. If you pull it out for personal usage, it's not deductible, right? Because then it's personal usage. If you put it, so what I like to call it is inventory, right? If you purchase some product and put it into inventory with the intent to sell it, so let's say you buy 500 of product X, and you take out $25 worth of, let's say you take out $500 worth of product X, and you take out $100 worth of product X to use for yourself, then you only have a $400 deductible. Does that make sense? Okay. Passport fees, no, because that's going to be personal. You can use the passport. That's one of those things where you can find some people would say yes, find some people would say no. I would be on the side that says no, because everyone is excited about deducting things until they get audited, right? So I wouldn't push that.
Okay, real quick. Someone said if they do a contest with the logo, is it deductible? But here's a preface to that. If it's a True Vision logo, we don't own True Vision Health. So if it says True Vision Health, is it a write-off because we're a 1099, or only if True Vision did their logo?
I can't hear you. There's a lot of background noise.
That someone isn't muted. If you aren't muted, I need you to mute your phone. It's interfering with the sound of everyone else, and everyone's trying to take something in here.
I heard that if you're giving away something with a True Vision logo. Now here's where it kind of gets a little gray, right? And this is where I'm going to be very careful with how I phrase this. So when there's a different, you can give away something with a True Vision logo and have it be advertising, so long as if the advertisement's more around you as a person and you as your brand, right? So, for example, I have Job White LLC, right? And that's a part of Reddish and White. Job White LLC is a part of Reddish and White. I can give away a product of Reddish and White under Job White LLC and deduct it directly from Job White LLC, so long as I'm branding and pushing Job White LLC, right? Because at that point, that's advertising, right? Do you follow me?
Right.
I mean, it's tricky because it's an area that when you do it, you just want to be mindful of how you do it. You want all the envelopes, all the little folded cards, all the everything to say brought to you by Alyssa, right? Brought to you by Job, brought to you by Terry, brought to you by Stacy. You want it to sit there and advertise your brand, which in your case is your name.
Not True Vision Health. So
exactly.
Like independent associate of True Vision Health, you can't write off stuff that just has True Vision Health on it because you don't own True Vision Health. You're an independent distributor of True Vision Health. So I think we need to be very clear there, because you all don't own True Vision Health. True Vision Health owns True Vision Health. I own Alyssa Marie Inc.
Exactly.
That's what I own.
So a good example of this is I have another example is sort of we have a couple of Yeti mugs. This is a sort of smaller example. We have a couple of Yeti mugs in our house. I put Reddish and White on my Yeti mugs, right? I put my logo on my Yeti mugs, right? And because that's advertising, everywhere I go with that, I'm showing my brand, right? So what you don't want what you don't want is to just put a business card in there. You want to show some intent that it's advertising. Put a little bit of effort into it, because at the end of the day, if you were to get pushed on it, you want to show that you did everything you could to make it advertising. Does that make sense?
Right.
So haphazardly just throwing a business card in there, someone would say, well, you could put a business card on anything then, right? You want to put a little bit more effort into it. Does that make sense?
Makes sense. So I think the most important thing is hire someone, like hire an expert.
Exactly.
That's why I hired you. You're worth every single penny.
Thank you.
I don't know this. So can you give them some tips and some questions to make for to find someone local to them, to find a great that is experienced in our industry? Because I think that's really iffy, because there are some people that call themselves a CPA and they may be great at traditional business, but they don't know about this industry. So do you have any tips on that?
Absolutely. 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 So the first tip is make sure you get a CPA. That's the first thing. Don't get a tax preparer. Don't get an EA. Don't go to H&R Block. Those three things are, a lot of people are trained and they're trained in a brief course. I'll give you an example. In order to become a CPA, you have to take something like 130 credit hours. You have to study under someone for 2 years. You have to take an exam that has like a 30% pass rate. It's more difficult to become a CPA in the state of Florida currently than it is to become an attorney. So a CPA is an expert. You don't want an EA. You don't want a tax preparer. You don't want just a bookkeeper or something like that in order to prepare your taxes. You want a CPA. That's the first qualifier. Additionally, what I would ask them is I would sit there and work with them, sit down with them, because not all CPAs sort of have the same approach to business. This is difficult because what I kind of qualify as a good CPA is someone who views you and your scope, everything you do. So we have a number of serial entrepreneur clients, right? People who have started multiple businesses or do multiple things. And the reason we pick them up is because a lot of CPAs can be very transactional, right? I give you material and they end up, I give you material, they process it, and then they just hand it back. They don't even consult you. They don't sit down with you. They don't work with you or anything. So what we like to do is we like to sit there and work with our clients, see where's this money coming from? How's it going here? What are you seeking to do? What are your retirement plans? How's everything going together? And through that, we kind of get the scope of a client. That's what you kind of want. And the best way to do that, to figure out if a CPA is like that, is meet with them in the summer. Don't meet with them now. Meet with them in the summer. And if they have time to sit down with you, then they're a good CPA. If they have no time to sit down with you in the summer, then they're probably a little overwhelmed and they're not going to answer many questions. The summer should be when CPAs are taking breaks because tax season's done. We do about 80% of our work in 4 months out of the year. 80% of our work in 4 months out of the year. I'm going to be working till 11 o'clock tonight. I'm going to be waking up early. I'm going to be working at 11 o'clock tomorrow night. It's the same thing day in, day out, but it ends April 15th, and it begins a little bit in September and October, but it ends April 15th, right? Now, that being said, meet with the CPA in the summer, because if they sit down with you and if they talk with you and they spend time with you, then they're a good CPA at the end of the day. How much does a CPA cost? It depends. It depends how much you're producing, how much time you take of theirs. It depends how many do you have rental properties? How many sources of income do you have? Do you have stock sales? It's kind of like saying, how much does it cost to paint a house, right? Well, how big is the house? How many windows does it have, right? If I'm painting just one wall, it can be cheap, but if I'm painting a mansion, it can be pretty expensive, right? I would say your average CPA on an individual return, most CPAs are going to specialize on people who are going into business. They're probably going to be about $450 to $650 on an individual return in your scope. That being said, you can easily find cheaper CPAs. Doesn't mean they're better, but you can easily find more expensive CPAs, and it doesn't mean they're better, right? It's just it depends on where you live, and it depends on the sort of access to industry on where you live. So I live in Gainesville, and I'm one of 3 CPAs my age. So my billing can be I can bill pretty high, like because there's very few CPAs in Gainesville willing to do what we're doing, right? But if you live somewhere in, like, say, Miami, in Miami, CPAs can be very cheap because there's a ton of CPAs. They're everywhere, right? And so it really depends on where you live. Is it too late to me to say? It's too late.
Here's a good question. One more.
Yes.
I think this is a good last question. What about seminars and educational courses?
Absolutely. Absolutely. All of that's deductible. Call it continued education. The best thing you can do for your CPA is keep an Excel sheet in your first couple of years of business, total, and to different subcategories, the annual amount of what you earned, what you bought in product, and give them different categories. Say, like, materials, call it purchases, inventory, right? And then you can say continued education, cell phone, advertising, gifts, supplies, office expenses. That's paper product, that's pens, that's notebooks, that's binders, all that stuff. Meals, entertainment, travel, telephone expense, home office deduction. Here's the square footage of my home. Here's the square footage of my office. I spent this much in rent, this much in utilities, this much in insurance, this much in home interest, all that stuff. Mileage, here's my business, here's my personal. Is it too late to meet with I'm going to answer this real quick. Is it too late to meet with the CPA it is too late to meet with the CPA in the summer? You made $1,100. Yeah, file on TurboTax. It's TurboTax is useful and it's easy. Honestly, if where you want a CPA is when you start when your business starts to lift off a little bit, when you're at the point where this happens all the time. People make $3,000 the first year. Then people make $9,000 the next year. Then they make $30,000 the next year. And the moment you see any sort of acceleration, you talk with the CPA. That second year, $9,000, start talking. Especially if you see in the current year that it's summertime and you've already made about $30,000 or you've already made $9,000, because then you're talking about doubling in size or tripling in size every year. Does that make sense?
Perfect. Thank you so much. I hope this was beneficial. I can't encourage enough, as your business starts to grow, it's so important to hire someone that knows what they're doing. So this is a small sample. It's a lot to learn. I've learned a lot as I was going, and obviously I still have a lot to learn, and thanks to him, it's been very beneficial for me and my business. So I appreciate you taking time out of your busy tax season to do this for us.
No problem. No problem. You're a great client, and I'm happy to help you. I live to serve. So at the end of the day, I'm blessed to have you as a client, and hopefully I can help ease up some people's lives and make it a little less confusing this time of year. You're welcome.
Perfect. Thank you so much. Y'all have a great day. Thanks for joining us.
You too. Bye.
Bye.